No one wants to pay more than their fair share in taxes, yet few have a good understanding of how their savings will be taxed over time. So a good way to gain a basic understanding is to consider this concept, the four tax buckets. The first bucket is your taxable bucket. These accounts are funded with after-tax dollars, so perhaps dollars that you already pay taxes on through your paycheck. Any accounts or financial vehicles that you pay taxes on each year, whether you pull the money out of the account or not, are going to fall into this bucket. So that's going to include bank accounts like savings, checking, money markets, CDs, or non-retirement investment accounts that may hold stocks or bonds. Anything that gives you a 1099 each year, even if you didn't pull the money out, falls into this taxable bucket. Hence, taxes owed are on what you make, not necessarily what you take. The second bucket is called the tax deferred bucket, meaning these accounts are funded with pre-tax dollars, so you get a deduction now, not to be taxed until you withdraw the money at a later point in time, generally in retirement. Think of this as paying taxes on the harvest, not the seed. Generally speaking, there are three primary vehicles that fall into this tax deferred bucket. Qualified employer-sponsored plans like 401ks or 403bs, IRAs, such as a simple IRA or a traditional IRA, defined benefit plans like pensions, and non-qualified annuities also fall into this bucket. The third bucket is the tax-free bucket, which is funded with after-tax dollars and accumulates to be withdrawn at a later date, tax-free. So this is like paying taxes on the seed, not the harvest. Again, there are primarily three financial vehicles that fall into this category: Roth IRAs, municipal bonds, and properly structured life insurance. Notice I said properly structured life insurance, so not all life insurance will fall into this category. Each has specific rules to follow to ensure they are tax-free, but nothing else falls into this bucket. And finally, the fourth bucket is income and estate tax-free, which is where you get into some special arrangements like charitable trusts and irrevocable trust. Keep in mind here, this requires transfer of ownership out of your estate. Now, here's what you need to know about these four tax buckets if you want to reduce taxes on your assets over time. You need to move your assets to the right. A common mistake many people make if their objective is to reduce their tax liability later in life is often right here. They have the majority of their assets accumulating in qualified retirement plans in bucket 2. This has the potential to create some tax liability down the road. So our suggestion is always, before deciding which financial vehicles are right for your retirement strategy, to consider the tax impacts that may come into play and diversify your savings over time. That's the concept of the four tax buckets.